Hi, I'm Bruce Youngblood of PensionSolutionsCanada.com. This is Jon Hreljac, who is Chartered Accountant, CA, CPA, and head of Tax and Estate Planning Department at Manulife.
So I'm going to go through a quick case study to show you how it might work from a tax perspective and from a cash flow perspective. And this is a real life example as to how I made sense for an individual to commute their pension in this particular case. And these are real life numbers from a real scenario. So we had Bob. He retired at age 60. This is from a GM pension. He had a spouse, Sue, 56. And back in 2020, his pension was going to commence, so a year ago. His estimated commuted value from his pension statement was nearly $600,000. And the pension benefit paid out about $42,000 a year from age 60 to 65. There was a slight step down in the middle there. Once he was 66 plus, that pension was going to be reduced to $25,000 a year. So it's a pretty nice pension, right? So the question becomes, right, can I commute the value of my pension and make this scenario make sense, right? Versus leaving the monies with the pension provider and have this guaranteed income for life. What rate of return do I need in the market to at least break even if that's my main concern? So I'm going to walk through some numbers, and this is how it looked. So the commuted value was $595,000. Of that $595,000, the maximum transfer value was $281,000. Okay, so that amount can go directly into a lira, which translated into a non-transferable portion or a taxable portion of $314,000. So he had to pay tax on $314,000. That being said, he did have RSP room of $134,000. This really helped with the numbers. So it makes it much more favorable. I mean, not much more favorable to make the decision, perhaps. So of that $314,000, he could shelter an additional $134,000 by doing a direct transfer into his RSP to minimize the tax liability on the non-transferable portion. So when Bob decided to commute his pension, this is what he ended up with. So the initial commuted value was nearly $600,000, but he put $282 into the lira, the maximum transfer value. He sheltered an additional $134,000 in his RSP, and then he had to pay a little bit of tax on the taxable portion to the extent that could not go into an RSP, and he paid tax of about $72,000, assuming a 40% marginal tax rate. Okay, so he ended up with $108,000 of non-registered money. So his total investment opportunity on that commuted value after tax was $524,000. Pretty good, okay, because he's already kind of paid the tax on that taxable portion, and now he has this nice, lump sum to work with on a go forward. So based on my numbers and the spreadsheet I utilize to help individuals with this type of calculation, and Bruce and I are happy to help you with this for your scenario, is that he just needed a 4.6 rate of return from this point forward to age 95 or year 2055 to simply match the pension. Okay, so not bad at all. That 4.6 rate of return, I believe, is easily attainable in the market over the course of time. And as a sidebar, I've done many pension calculations where the annual rate of return required is much lower than 4.6%, perhaps 3%, 2.5%, 3.5%. It all depends where the numbers land. It depends on the commuted value. It depends on how much can be sheltered into a lira, the available RSP room, other various factors. But sometimes that assumed rate of return is much less than 4.6%. So which obviously makes it a little more favorable, at least to match the pension. Obviously, if you earn over 4.6% over the course of time, which is, again, attainable, perhaps you can increase the pension. You can withdraw more money out of the course of time. Or the money could last longer if you're going to live beyond age 95. The nice thing about this too, right? If Bob were to predecease at an early age, well, his wife doesn't have to worry about having that 66 2/3 reduction. She can still effectively reduce or receive the same amount of monies from that income stream from his various investments. Because this is a screenshot of simply what it looks like having the money from his pension plan or what it looked like to withdraw money from his various pots of income over the course of time on a proportionate basis from his LIRA and RSP and his non-reg money. But I'm just showing what it looks like, conceptually earning that 4.6 rate of return in the market. I have an excellent spreadsheet that helps run these numbers. Bruce can help you go through them if that applies to you. And if we do a commuted value scenario for yourself. Lastly, this is a powerful slide in my mind, the estate planning value of a pension. So Bob, for example, let's say Bob were to pass away at age 80, okay, which I don't think is too unreasonable, and his wife was already passed away as well, or was shortly there behind. Well, he still would have $275,000 in his investments, okay, about 56,000 in his non-reg, about 218,000 in his LIRA and RSP, assuming he's receiving that 4.6 rate of return over the course of time and taking income out simply to match the pension. So he dies at age 80. He has, again, $250,000 that can be passed on to, say, his children as a nest egg. So very powerful in my mind. If he, left the monies with a pension provider, there'd be nothing you pass on from an estate planning perspective. The earlier you pass away, obviously the bigger the nest egg. So I think this is a very important conversation to have with clients, or with yourself in thinking about estate planning and commuting a value.
As I said, John's an accountant and can help us with the math on this commuted value decision. So follow up, just get a hold of me, Pension Solutions Canada, Bruce Youngblood. Happy to go over this with you. Happy to help you walk through the commuted value decision, of course. Thanks very much to Jon Hreljac, Manulife CA CPA today.
Thank you.